Welcome to another episode of Managing Your Money. I'm Adam Strauss, partner at Pekin Hardy Strauss Wealth Management, and I'm here with three of my partners, Matt Bloom, Josh Strauss, and Bill Pekin. We're here to talk about where we are in the inflation cycle. Inflation peaked in 2022, around 9%. I think it was a 40-year high, something like that. And ever since then, inflation has been declining to the point where I think it got down at or close to 3% recently. At the end of 2023, we heard Jerome Powell talking about the possibility of interest rate cuts in 2024 due to the fact that the inflation battle might be over or soon near over. So it prompts the question about this call. Where are we in the inflation cycle? Is inflation vanquished? What do you think?
That's a multi-trillion-dollar question, Adam.
What do you think, Josh?
I think there's a lot of different factors playing into inflation over time. So you've got the fact that since 2008, the Fed has kept a very low rate of interest, which stokes prices, and that was their express goal for many years. And then you had COVID coming in, and the government really put an enormous spike in spending, really pushing the government debt, at very high levels, and which was one of the primary factors to really spike inflation to that 9% that you referenced. And then the Fed, of course, tried to put the brakes on by raising the short end of the curve. And it's had an impact on lowering inflation on a short-term basis. But I think the bigger issues are some of the structural issues associated with inflation. We have the Fed is between a rock and a hard place in that right now interest coverage is a higher expense than that of the cost for the Defense Department, and so they're more likely to cut rates than to raise rates, particularly in a presidential year, which will stoke inflation. There have been several CEOs of oil and gas companies calling for a significant reduction in oil production here in the United States next year, as fracking impact has really played itself out, and we're going to see a lot less production in the U.S., which will result in more inflation, let alone the fact that we've had, maybe a decade of underinvestment in infrastructure, which will also stoke the levels of inflation. So I personally look at this as a short-term lull in a multi-year inflationary environment. It's good to see the rate of inflation come down. It's good for our clients. It's good for stock and bond prices. But I think it's a little too early to call it victory.
Well, one follow-up question before I turn to Matt and Bill. You mentioned interest rates and the rise of interest rates in being deflationary. I've heard arguments of the opposite, which is that there's been an enormous deficit in 2023, driven largely by the fact that interest rates have risen. So that's causing a lot more income to go into the hands of people who own bonds than before, and is sort of inflationary. Because it's basically government spending, admittedly in the form of interest payments, that's going into the economy. What do you think about that argument?
That's a good question. I'm not sure. I think, look, I haven't done the numbers to see the dollar impact. Maybe, to understand the additional income.
Well, you just said interest payments are now above defense spending. That is a fact, right?
Right. No, I'm thinking about, the impact of, the increased interest expense relative to GDP, and to the extent to which that has. Because I think there's a put and a take there. So your point is well taken. That's true, but at the same time, it gives corporations and investors a bit of a pause into whether or not they want to invest in capital expenditures. Would you want to invest in a company that's going to build a new factory, or do you just want to clip your coupon? And so there's a negative countervailing force associated with the impact of inflation. So I think it's a mixed bag. I would say overall, and I'm guessing here that the increase on the short end of the curve is a deflationary force overall. It has been historically. I don't know why it'd be that different now. That certainly was the case in the 1980s, the last time we saw a giant spike in short end of the yield curve. But these are blunt instruments that the Fed has to control inflation and work on employment, and there are puts and takes associated with using these tools.
All right. Who else would like to weigh in?
I'll jump in. I mean, yeah, you raised a lot of both you raised a lot of good points. I mean, there is an argument to be made that people think that 5% short-term interest rates are stimulus payments to the affluent, and therefore that's driving spending and keeping inflation higher. But that certainly runs counter to what Josh talked about, which is historically when the Fed has raised short-term rates, that has acted as a deflationary force. And maybe the economy is different now. I'm sure it is in many ways than what it was in the 70s and 80s. So it's hard to know. Maybe if I can share my screen for a second. Yeah, I thought this picture was kind of interesting. Some of you may have seen this before. It's from Crest Capital. They draw this kind of three inflationary waves in the 1970s, which Josh was referring to in some ways. And here is this "you are here." Now, whether that's true or not is unclear. But interestingly enough, we had a major growth stock bubble that peaked in 1972. Post towards the end of the Vietnam War, and then we had these multiple waves of inflation. Some suggest there are parallels today to that growth stock bubble in 1972, and that if that parallel holds, maybe this parallel will hold as well. Maybe we are facing multiple waves of future inflation. I think that if you look at the 70s analog, at least, it was very, very hard to bring inflation down. It wasn't just one wave. And logically speaking, history will say once the toothpaste has come out of that tube, it's very hard to put it back in. Once inflation gets over a general level of 5%, once you get a 5% CPI number, historically, it's been very hard to get that number down. This bout of inflation in the 1970s took 6 to probably 10 years or 6 to 8 years of the Fed raising, to Josh's point, short-term rates ever higher to a peak of 18% before inflation was finally defeated, as you saw in the early 1980s. If you drew Fed funds here, it would be up here. Today we've just gone through 1 year or 1.5 years of the Fed raising rates to 5.25%, and inflation's as big as it was certainly at the peak in the 70s, but certainly sustainably higher today as it was in the early 70s. And it begs the question, can 1 year of raising rates up to 5 or 5.5, let's say, be enough to counter the biggest wave of inflation we've seen since the 1970s? And I would argue that it's highly unlikely. It's highly unlikely. And I'll share another chart.
So Bill, if I could just interrupt.
Yeah.
So you have this "you are here" arrow in the chart. Is that's where you think we are, which is like at a temporary bottom and about to go way back up?
Yeah, if I had to guess, yes. And I don't know if these numbers. I'm not saying the direction. I'm not saying that inflation will get as high as it got in the 70s. I'm using this as an analog chart, but yes.
Right. You could argue it could go higher in the 70s. It looks like their first wave peaked around 6%. If we already had our first wave peak at 9%, watch out.
It's true. It's true. I just say this and I don't know if we're here exactly, but again, it's just an analog. Josh was talking about this kind of mission accomplished. I think it's too soon for the Fed to trot out the mission accomplished banner, because I think historically speaking, one wave of inflation, once they get above a certain level, and generally that's 5%, it doesn't just subside. And that's my point. This did not subside magically in the 70s, and to make it subside, or to get this to subside, took a much stricter, much tighter Fed monetary policy than we're seeing today, and candidly than we could afford to do today, because debt to GDP is so much higher than it was in the 70s.
Great. Okay.
Wait. So I guess the one question you brought up a lot of good points, but one question that comes to mind for me is why is it that 5% number is a little bit like, trying to put that toothpaste back in the bottle? Why would what is so magical about that 5%, and then if you reduce that, you couldn't just see it, you actually did stuff the toothpaste in the bottle. And make no mistake, I don't think that the mission's accomplished. I'm just saying, just asking this, playing devil's advocate here.
Yeah, no, it's a really good question. I don't have the data to answer that question. I have just read that historically, and maybe it's just because, at least in modern and kind of the last 100 years or modern times, or in the modern economy that we're in today, that in the US inflation has averaged around 3% or so. So maybe 5% is an unusually high rating of inflation. So once we get to these higher levels, they tend to be harder to put back down. But I'm speculating there on that.
Well, I mean, I would argue, and I was actually going to say this, in relation to like some of the other driving factors, but I mean, there's a really psychological piece of this too, right? I mean, part of inflation, a big part of inflation is inflation expectations. And what we've seen happen historically is that once inflation gets to sort of a certain level, and Billy, you're kind of saying that's, maybe around 5%, like, I think that the broader economy, people start to expect inflation to remain high, right? They hear that, oh, it's 5%, that's a significant rate of inflation. And they start to anchor to those higher numbers, and the expectations go up, and then that sort of leads to further inflation, right? And I think that's why it becomes so difficult to put the genie back in the bottle, or the toothpaste back in the tube, because then it becomes a psychological factor. But I would also, say something related to, the things that Josh was discussing earlier, some of these different factors. I think there's some really big long-term structural factors too that I think people have lost sight of, or not fully accounting for. Like, back when we were able to, the early to mid 2000s, we were able to print money with reckless abandon, and it was okay because it got sopped up by the low labor costs in emerging markets, right? That has largely played out. In the US also, we have major demographic issues that we're facing. And these are not things that are just going to be sorted out in the next 6 to 12 months. These are things that take, potentially decades to change. We have all these baby boomers retiring, right? Coming out of the workforce. We have, increased healthcare costs and things like that. So there are just a lot of these demographic issues that we face in the US, but not just the US, other Western countries as well. And when you pair that with some of the deglobalization and the increase in standard of living and cost of living in some of these emerging market countries, you see these much longer tailed structural types of drivers for inflation that I think are going to make it difficult to come all the way back down to the Fed's target. And it's not to suggest that we would remain at like the 9-10% level, but that even if the Fed gets inflation, or maybe they've kind of gotten it a little bit under control, but I could very well see it in that mid-single digit range for a very long time, just because of some of these bigger long-term structural issues.
Those are great points, Matt.
Can we talk about the I mean, just to play devil's advocate for a minute, can we talk a little bit about some of the deflationary forces in the economy? We've got war in Ukraine, right? War.
Inflationary.
Yeah, inflationary.
That's
Wars are
inflationary.
They're always inflationary in
Wars are
regards to
inflationary.
financial assets
Yes,
too.
they
They're
cost
always
money.
inflationary.
I mean,
So how come we haven't seen that this year, particularly with a second war in the Middle East?
Well, the war in Ukraine absolutely contributed to a lot of the inflation that occurred in 2022, right? The war started in 2022, and that's
Right.
when energy prices really skyrocketed. So in 2023, one of the reasons that it's moderating is you've got a comparison to 2022, but the war is still going on. And I would argue, I mean, this doesn't have to do with war, or maybe it does, I guess, indirectly, but a big contributor to the CPI decline that's happened over the last 15 months or so is that energy prices have declined, and that decline has been driven by the sales that have occurred part of the Biden administration out of the Strategic Petroleum Reserve. There's been an enormous amount of one-time additional supply of oil, and that has brought oil prices down, and that has helped to bring inflation down. And the result is, when you combine commercial inventories plus the Strategic Petroleum Reserve, we're at a 40-year low of oil inventories, which is very inflationary. But in the short run, it's brought the CPI down. But war is inflation. You know, the war in Israel, you know, I would argue that that has not been inflationary because thus far it's been a pretty small, unimportant war when it comes to energy supplies. If it starts to affect energy in a big way, it'll be inflationary too.
Right, right. And again, you know, playing devil's advocate here, what about the massive impact that AI is going to have on our lives over the next 5 years, which I look at as, you know, possible huge productivity improvements, and which would, you know, hopefully keep inflation in check over some period of time. You know, certainly today AI has a, you know, near zero impact on the economy, but, you know, in terms of the next few years, is this something where we need to be thinking about that it having a, you know, material impact on our lives going forward?
I'll I'll take a stab at that. I mean, certainly the prospect of AI being a productivity enhancer is what has propped up a lot of these AI stocks, right? They are trading on the fact that AI will revolutionize our lives and increase productivity immensely, and that may happen, or it may not happen until much later, as I would probably argue. But that's just one component of inflation. You know, it would affect, I would presume, labor cost to some degree if you can do more with less people, or you would have to keep labor prices lower, since you can substitute technology for, or, you know, technology capital for labor. But, you know, to Abner's point, if energy prices climb for various reasons, that will still be inflationary. If energy prices go up, then generally food prices go up, and those are inflationary components. If AI does increase productivity in just some parts of the economy, but not in other, and wages are still strong in lower parts of the economy, then it may not be a cure-all for wages. And what you're seeing now is, interestingly enough, for the first time, blue collar wages are growing faster than white collar wages. So maybe AI, which seems to affect mostly white collar jobs, maybe it depresses wages in the white collar sector, but you still have blue collar wages because we're just underserviced or undermanned, or underpeopled in those sectors. And so the wages are high. So I guess to your point, there are puts and takes. It's unclear whether AI will be a wholly deflationary force or not.
Yeah, and then, you know, to drive all these AI engines, you need chips, do you not? And to have chips, you need fabs. And if AI is going to be this revolutionary force that's going to change the way we live and work, you're going to need an enormous amount of production of the physical components of the AI, the AI generators and whatnot. And so, okay, you got to build a massive fab plant here, and you need tons of materials for that. You need tons of energy for that. You know, you need solid infrastructure to create all of this stuff, right? It's not just code. There's
And the power to, right, to fuel all that AI, right? The power to keep it all running, right?
Run all those data centers and everything. That's, I mean, that is not insignificant. So there's, like Billy said, basically, yes, you might have a deflationary force on one side, but you have inflationary forces on the other that are coupled with it. So I don't think you can just call AI a deflationary force. It has both sides, I think.
So why is it, again, devil's advocate, the world, and you read the financial press, it's all about the soft landing is happening. And why are we such a contrary view compared to everybody else? Like, you know, are they just looking at the next 3 months, 6 months, 12 months, and we have a longer term view? You know, why is there such a the four of us, it seems to me, are on one side of the equation. Why is the rest of the world on the other side of the equation right now?
Well, the financial press is always a good contrarian indicator, so I'm not sure why that would be
Fair.
useful at
Okay.
all, except to go against it. But I actually I've got I mean a reason why we could be wrong, at least in the short run, which is that if you look at the leading economic indicators, they've been declining for months and months and months with no sign of turning up again. The housing bubble, which caused the financial crisis, the financial crisis occurred in 2008, but the housing bubble peaked really in around 2005 or so. It took 3 years for it to finally hit financial markets, and when it did, it was massively deflationary. I think from the numbers that I've looked at, that the commercial real estate market is every bit as big as the housing market. And it seems to me like there could be a potential crisis brewing there. And if we see some kind of a massive bust with banks going under and institutional investors over-levered on commercial credit or whatever, I think there's potential for a pretty significant deflationary wave to come out of commercial real estate that we clearly haven't seen it yet, but I think we could see it. I think it's, I think that could, now again, it might not ruin the long-term inflationary thesis, but it could cause a lot more deflation than everybody's expecting right now.
Yeah, well, that's a hard landing. I mean,
That's a hard landing. Fair enough.
Yeah,
That's yes.
yeah,
That's a hard
yeah. I mean,
landing.
I think what you're saying, Adam, I think is important because it could be in the near to medium term could be a major deflationary force that really totally throws off what we're seeing from an inflation standpoint. But that has all kinds of other implications associated with it, and ultimately could lead to the next massive inflationary wave as the government is likely to step in and do
Right, there'll be a big
whatever is
bailout.
necessary. They've shown over the last couple of years that there are no limits to what they'll do. But I think what Josh is more referring to is this idea that, hey, you know what, inflation has come down to a much more manageable level. It's under control. The Fed has made substantial progress toward getting it back to their goal level, and not only that, but we didn't wreck the economy.
Yeah.
And now, that broader sort of belief out in the market, I guess I kind of think it's because a lot of people don't realize what the government has been doing from a spending standpoint. I don't think they understand why the economy hasn't gone into recession.
Yeah.
And so, but like the government can't do that indefinitely for free. There's a cost to what they've done from a spending standpoint, and ultimately, I think that cost is more inflation.
Yeah.
So,
yeah. I think
I think well,
Go ahead,
those are all great points. And Adam's point, in theory, you're right. If markets were allowed to function the way they have been in the past, then real estate busts as we saw with the S&L crisis and the 08-09 crisis, have been deflationary. But recently, or post 08-09, the government hasn't allowed those busts to happen. So, now to Matt's point is, every time when we saw 3 banks or 4 banks fail a year ago, and that was met with new on the fly programs, the rules totally changed. And, we had the bank term lending, the bank term funding term program, whatever it was called. I can't pronounce the acronym, right? Where the rules changed and the banks could trade in their under par treasuries for par all of a sudden, and capital was provided to the system instead of letting banks fail and deflation happen. So I would argue that the next crisis, whether it be commercial real estate or something else, will not be deflationary likely, but will be inflationary again. The Fed has showed its hand that it won't let a deflationary collapse happen. Now, why is that? Because likely, once you're as levered as this government is, you can't let deflation happen. That's the worst possible thing. When you are a debtor, as much in debt as we are, deflation is the absolute enemy, and which is probably also why the Fed was so scared during the deflationary forces of COVID. COVID was the poster child of a deflationary accident happening, right? The whole world was going to shut down because of a pandemic. And what did the Fed do? Not every government did this. The Fed flooded the system with money. The Fed was terrified of a deflationary shock. And I would suggest that if we get another one from CRE or something else, that something similar will likely happen.
Yeah. I mean, it also seems like we've been talking a lot about sort of long-term structural forces over the next 5 years or so, et cetera, et cetera. But if you just look at data today, like current data, there's stuff that's coming out that shows that, we're probably at a bottom of inflation, that whatever declines in inflation we saw is pretty much done. I saw a chart last week that showed that government wages are now up 10% year over year. Employers are wage increases that employers are planning had been going down and are now spiking back up again. So employers are planning on increasing their wage increases. And then the most recent CPI print, apparently the measure that the Federal Reserve mostly looks at or looks at more than anything else to see how inflation is this subset of the consumer price index called core services x housing services. So I think that's like the CPI minus all of the sort of energy changes and minus housing. And that supposedly is a more stable number that they really look at for guidance on where things are going. The last print from a couple of weeks ago was 0.88% month over month, which annualizes at 10.5%. So if that's any kind of indication of what kind of trend we have going forward, I think it supports the idea that that we probably are at a bottom. So let's move on to the next topic related to inflation. I think we've heard a lot of the arguments for and some good arguments against. We've got an election this year. What impact will the coming election have on inflation? Both, I guess, the election season, as well as does it matter who wins in terms of where inflation is going? What do you think?
I think for the election season, inflation is more likely to be in check in the short term. Joe Biden wants to get reelected, and he has levers to pull in order to try to get reelected, both economically and otherwise. And I think he's going to do everything he can in order to keep inflation in check. Because if people are feeling the pinch of inflation, they're not going to vote for him. They're going to blame him for inflation more so than they already have.
So you think he's very focused on fighting inflation and wants to make sure that inflation stays down?
Certainly in the short term, I think I think that it doesn't matter that it's Joe Biden or somebody else. His administration, whose ever administration it is, in an election year, they want a good economy, right? People remember what happened this week, not last week.
But to keeping inflation in check and providing a good economy in some ways are at odds, right? I mean, because historically we've seen a lot of spending in election seasons because they want a good economy, right? So I do think you're right that this administration has been lambasted for inflation, and so I know that it is something that they want to at least they want to create the optics that inflation is under control. I think if they had the ability to release another few 100 million barrels of oil, they would to keep oil prices low. I think that they're going to continue to do whatever they can on that front, but they have to balance that with making sure that they don't see a big uptick in unemployment or something like that, right? So they have to keep the spigots open to keep the economy humming, in advance of the election, because they don't want to get hammered on that side of it. So I think they're kind of between a rock and a hard place. So my personal belief is that we're more likely to see higher inflation leading into an election, but that's an opinion.
Yeah, I kind of agree with you, Matt. I mean, I think the thing about inflation is it's not always clear where it comes from. So you can blame it on others. Yeah, so if inflation comes in hot this year, okay. Yeah, it's the fault of big corporations. It's the fault of Russia. It's the fault of the Federal Reserve. It's the fault of Congress. There's all kinds of things you can do. If the economy tanks and people lose their job and become unemployed, that's, it's I think that's just harder to blame on others.
Yeah, I think you're right. I think to Matt, a full economy and inflation or low inflation is kind of at odds with each other, right? So if you raise interest rates too much to combat the inflation, you tend to hurt the economy. I think people tend to like full employment, and so I tend to think that they'll run this economy hot going into this election, even if inflation is the byproduct, which is why I think things will likely be inflationary, because I think they'll run this economy hot to try to get asset prices up, to try to get jobs up, to try to make as many people happy as possible. Of course, inflation hurts people, and Josh, you're right, but I think that is the byproduct of all this. And to go one step further, Adam asked about post-election. I don't think it matters who wins. I think it'll be inflationary. I think this government shows no signs of stopping their spending. I think the fiscal year for the government starts October 1st, and I think the first 2 or 3 months of the year that the budget's been out, fiscal spending is up 17% year over year. That's just a tremendous increase, and there's no signs of that stopping. We are subsidizing 2 wars. There's other spending going on, and so it's hard to, again, if you go back to Volcker, basically he shut down everything to combat inflation, right? He shut down the economy. Here we have an economy that's running on full. We had a horrible recession in the early 1980s that was deflationary, that helped bring down inflation. Here, there's nothing that is part of government policy that is deflationary. In fact, to everything else, whether it's higher interest rates that are spurring these interest payments or massive amounts of government spending with no end in sight, all that leads to something that's likely going to be inflationary.
So you think it doesn't matter who wins the election, it's all equally inflationary?
I think they're all going to spend. I don't think either party has shown any discipline on the spending side.
Does anybody want to disagree with Billy's view here?
No.
Well, I mean, once you look at Social Security, Medicare, and the Defense Department, isn't that, and it's somewhere I can't remember exactly. It's somewhere between 2/3 and 3/4 of the budget anyway, right?
And then add interest too.
Right. So there's just only so many levers you can pull,
Right.
and I mean, part of me wonders like which president is going to have a more positive impact on inflation. Both of them want to get keep their parties in power, and I think that that's all about either tax and spend on one side or tax less and spend more. I don't know. Either way, inflation is in the cards in the near term.
Yeah, if I could just jump in just quickly, I think the other thing is that I think it was Reinhard Rogoff who wrote the seminal book on debt and inflation, or debt or government debt, and after the 2008-09 crisis. Their study was, at least in the last 125 years, every time an economy got to something like 100 to 120% of debt to GDP, the outcome was either default, deflation on one end, which more happens to countries that can't print the currency to pay their debt. If their debt is dominated in other currencies, we fortunately can have a printing press, and so it's unlikely that we'll default because we can just print the dollars to pay our debts. Or the other option is inflation. Since default is not technically possible for us, or likely not possible because we can print to pay off our debts, the other path is inflation. We're at the stage where we don't really have another choice.
Mm-hmm. Okay, well, I think that I don't know that it's 100% consensus, but I think there's a fairly good consensus among the 4 of us that inflation is likely to reaccelerate, if not immediately, relatively short order. I think on January 12th, I read that the futures market had priced in 7 cuts to the Fed funds rate this year. And I think that number is down to 3, which means that as new data has come out, the market is starting to think, well, maybe inflation isn't quite vanquished or as vanquished as we thought it was. Maybe there is some risk here that we're not quite done here yet, or that if inflation is vanquished, it's only a little bit vanquished. I guess the question is, if inflation reaccelerates, where do things go? What do you want to own? What do you think about short-term bonds, long-term bonds, stocks, alternatives? What do you want to invest in, and what do you want to avoid?
Well, I think, there's that old saying that, when you're in a war, and wars are inflationary, and we are in wars right now, the first casualty is the truth because of propaganda, and the second casualty are the bondholders. So I think you don't want to be a long-term bondholder. If we're right about inflation, then in real terms, you might be paid back in nominal terms, but in real terms, that's not going to be a great investment. So one is I would keep your bond holdings short. You're paid certainly now, as Josh said, you're paid. You have an inverted yield curve, so you're paid more on the short end than you are on the long end. So it behooves you to stay at that short end. And I would tend to think, even though we're positioned differently than the Goldilocks scenario, that the market generally is positioned. But we just talked about the market can change, or consensus can change quickly. Consensus was 7 rate cuts just 2 months ago, and now we're down to 2 rate cuts. Consensus today is we are in immaculate disinflation, or a Goldilocks scenario, and that can change as the data changes. And as the data changes, I think it's likely going to be inflationary, or inflation will prove to be persistently stickier than the market is discounting right now. And that means, to Adam's point, is I think you want to own scarcity assets. I think you want to own generally commodities, gold, energy. You want to own real assets that historically tend to outperform in inflationary environments.
Matt, what are your thoughts?
Well, first of all, I agree with everything that Bill said. I mean, if we earlier were talking about analogs to the 70s, right? If we're in anything like the 70s, then you go back and you look at what worked in the 70s and what didn't, and basically it follows what Bill just said. You don't want to be certainly a long-term bondholder, and you do want to own the energy commodity, sort of gold complex, right? Anything that's a real asset, those are the sorts of things you want to have your hands on. I mean, certainly, equities generally have, versus things like bonds have tended to perform better in inflationary environments. But certainly within that, I think that the best things to own are going to be the commodity materials, energy type investments. So, that I think that Billy's spot on with that.
Josh?
I mean, it's hard to argue with what Billy said. I mean, if you look at the 1970s, as history doesn't repeat itself, but it certainly does rhyme. But if you X out inflation, there was only 2 asset classes that generated a positive rate of return during that time period, which was gold miners and oil and gas exploration companies. Yeah, the economy is a lot different now, and oil and gas is a much smaller proportion of the S&P 500, and gold miners don't really matter that much. Are we moving towards Bitcoin and other forms of digital currency instead of gold? Blah blah blah. That's you talk that argument, but I think the same thing is going to happen. I think either way, you're going to see, as Billy called it, scarce assets perform well. And that's commodities, that's agriculture, that's oil and gas, that's nuclear energy, that's companies with, and then I think past a little further is companies with very high fixed costs should do an okay job of being okay, because their costs have already been baked in.
Real quick, sorry, I would just add too, if you're looking sort of outside what we've just been saying, companies with really strong brands, right, that have the ability to push through cost increases. That there are certainly businesses that have the ability to pass on higher costs because their brands are very strong, or because they sell to a certain type of consumer. There are certainly companies that will weather continued inflation better than others.
I want to ask a question about gold. In the we've been using the 1970s as an analog. In the 1970s, I think the gold price appreciated on a compound basis over the course of that decade by over 20% a year, adjusted for inflation. So 20% return above and beyond the inflation rate during the 1970s, which was not an insignificant inflation rate. Well, gold has been it's been better than stocks over the last couple of years. But if you look at the current price of gold, it's not a whole lot different than it was in at the peak in 2020. And the general price level has risen enormously since 2020. So what makes us think that gold is going to repeat the 1970s, given that it's been sort of flattish over the last 4 years during a period of quite a bit of inflation?
Well, I would argue a couple things. Gold quietly now, of course, your start and end points matter a lot here, but gold since 2000 has outperformed the S&P 500. It's been a quiet outperformance and really a largely unrecognized performance. So one is perception. Two is, from the bottom of this cycle, at least circa 2015, when gold was $1,000, gold has doubled in, so what is that, not 9 years, which probably outperforms the S&P, although I don't know, maybe it's close. And two is, you're right that gold has had a hard time breaking through the all-time highs that occurred in August of 2020. That said, you have a major dislocation today between Western buyers and gold. Usually gold bull markets correspond with Western buyers coming in and bidding up the price of gold and gold miners. And today, basically, despite the fact that gold is hanging around $2,000 an ounce and all-time highs, it's not talked about at all in the West, and there's constant outflows of gold ETFs in the West. So, I would argue that whenever the market begins to discount the fact that we are not in Goldilocks and that we are in a higher for longer inflationary environment, that the market will rotate to those inflation havens, and I think gold will appreciate them.
Good. Thank you, Bill. That's helpful.
Billy, has gold been replaced by Bitcoin and other cryptos?
Yeah, there is an argument to some people believe that. Certainly the flows into the Bitcoin ETFs have been much greater than the flows into the gold ETF. Certainly gold ETFs have seen, I think, net outflows this year, and maybe even the last 6 months. And the Bitcoin ETFs obviously are net positive by a very wide margin. But I don't think it's either or. I think they're both scarcity assets, and I think gold and Bitcoin can both coexist. So I don't think that Bitcoin takes the place of gold. There are attributes of Bitcoin that are more attractive than gold, and there are certainly attributes of gold that are more attractive than Bitcoin, and risk to both. So I think both should do well in this environment. Bitcoin generally tends to do well in robust markets, and gold tends to do well in more defensive markets. We certainly have a robust stock market today, but whenever that shifts, then I think gold will likely outshine.
Final question. So how do you think the traditional 60-40 portfolio is going to do if all of our inflation forecasts come to fruition?
Not so well. I mean, just look at 2022, right? It depends a lot on what happens with the Fed and whatnot, but it will not be good for the 60-40 because the 40 side will, I think, get hit pretty bad. As we were saying, you don't really want to be a bondholder, especially a longer maturity bondholder in an inflationary environment. You're going to have potentially real losses there, right? Inflation adjusted, and so I don't think it's a positive for 60-40. And if you follow the 60-40, you don't, that implies that you don't have any physical gold holdings or anything like that to help sort of counterbalance the inflation effect. So I think it would certainly be a negative for the 60-40.
Well, and to your point, Adam, I mean, for the 60-40, I don't know, from the last 15 years up until 2020, let's say, bonds and stocks were negatively correlated. So the 60-40 portfolio worked magically. We certainly saw that happen in 2008-9, and in during the market dislocations of 2000-2002, where bonds acted as a brake to stocks, or bonds went up as the stock market went down. They were negatively correlated. That correlation broke for many reasons that we don't have time to get into now in March 2020, and since then, largely stocks and bonds have been positively correlated. So that undercuts the thesis of the 60-40 portfolio. If the 40 isn't a negative correlation anymore, and as you see, long-term treasuries have been horrible since 2020. They have not been a kind of an anti-fragile asset. Then that begs the question: what's the point of the 60-40 portfolio? Is the 60-40 portfolio over, as Matt said? And I think it is in this environment, in positive correlation environments. What is the new anti-fragile asset? I would argue it's likely gold is the new anti-fragile asset. Certainly, gold has way outperformed U.S. Treasury bonds, long-term U.S. Treasury bonds, the last 3 years, and certainly over the last 20 years, but in particular the last 3 years. But I think investors need to search for a different 40, a different anti-fragile or combination of anti-fragile assets. I don't think long-term Treasury bonds or long-term U.S. bonds in general will fit that bill.
Okay, anything anybody wants to say about inflation or the implications of inflation before we close out this this call?
I guess it's just, I'm just thinking about it. It's just, it's very depressing call that we've just done. When you think about it, it's you have, you look at the stock markets. The stock market was strong in 2023. So far, it's off to a good year. It's which is all true. And then here we are, all gloom and doom on this call. And I guess the question is what yes, what happens if we're wrong, right? And should you be exposed to go growth stocks or fixed income, or do you just say it's simply just not worth the risk? I think I would argue that it's simply not worth the risk. And in the short term, it's possible that you might underperform, but you're well positioned for that inflationary environment for when it does come.
Well, first, I just want to say I don't think it's necessarily doom and gloom call. Talking about inflation isn't necessarily gloomy. I mean, there are lots of ways to make money. And as Matt pointed out, in the 1970s, if you were in the right asset classes, even in the depressionary 30s and in the stagflationary 70s, you could make money. Our job is to find those asset classes for our clients. So I don't think it's all hope is lost here. I just think it's recognizing that the world is likely changing, that we're likely in a structurally different environment than we were, a different cycle than we were than we saw the last disinflationary 15 or so years. So it's not to say that all is lost at all, but I just think the market environment is different. But to your point, Josh, we could be wrong here. We tend to be biased towards inflation, and you're right. I mean, the AI boom that is happening now could turn out to be a productivity miracle, and it could be a major deflationary force in ways that we can't fathom right now, and in which case we're positioned probably incorrectly. So that is a possibility. I mean, I think it's a lower probability, but it's certainly a possibility.
Certainly seems, again, looking at the probabilities, as Bill pointed out, it seems like probabilistically the right way to position oneself in the environment that we're in today is using a non-traditional approach. The 60-40 portfolio isn't going to cut it. You're going to need to look at the individual companies that you own differently. You're going to need to be selective by picking individual stocks that could do well in an inflationary environment rather than just mindlessly owning a passive investment index. You're going to have to own hard assets. You're going to have to own alternatives like gold. It's a different approach than what you would normally do when inflation is declining or remaining low. Is that fair?
That's right.
Yeah, I think it's very fair.
Yeah. Okay, good. So let's close it out with that then. Thank you, all three of you, for your contributions. And anybody who's watching, thank you for watching. This is another episode of Managing Your Money. We'll see you next time.